Welcome to the Year-End Tax and Financial Planning webinar hosted by Stephens Wealth Management and Pearl Planning. My name is Melissa Joy, and I'm founder of Pearl Planning located in Dexter, Michigan near Ann Arbor. I'm pleased to be joining Sherry Stephens, president of Stephens Wealth Management Group of Flint, Michigan, for an informative conversation on current financial and tax planning topics. Before we get started, I'd like to share with you our agenda. We'll be talking about the partnership between Stephens Wealth Management and Pearl Planning. We'll be providing you with an update on the Tax Cuts and Jobs Act of 2017. Then we'll go into effective charitable giving, enrollment reminders, and the most pertinent strategies that we're recommending for clients right now, as well as some reminders about the tax season in early 2019. There's a few things I want to note about this webinar. This program is scheduled to run for 30 minutes, and we'll do our best to stick close to our allotted time. Please note that we will be recording this program for future reviews, and we'll be linking it to our websites afterwards. If you have any questions, be sure to write them down and email us at the conclusion of the presentation, or feel free to call our offices. We'll provide you email addresses so that you can send them to us at the end of the presentation, and we'll reply promptly to all of your inquiries. Now, there's one thing that we did not include on the agenda, which is recent market volatility, but we know you may have a couple questions on that and how it fits in context with your portfolios. Sherry, this will take a minute to introduce you, and I want to hear, what are you telling clients?
Great to present with you today, Melissa. And yes, we've had some market volatility lately, haven't we? About 10% down from the high lately. We actually had a 10% correction in February as well. Historically, corrections aren't that unusual. We've just had such a calm in the last year that it's starting to become more volatile and feels maybe a little unusual. There's actually been about 12 corrections in the last 12 years between 5 and 10%. So while it's usually not a reason to make any big changes, just give us a call if you have questions about your specific situation, and we can go over anything that you'd like to cover.
I like to remind clients like you that this is a time where we really earn our keep by communicating and working together so that you can understand how changes in investments affect your portfolios. So let's talk a little bit about the partnership of Pearl Planning and Stephens Wealth, because this is something that is new in 2018. Pearl Planning is a new practice that aligned with Raymond James Financial Services and Stephens Wealth in August 2018. I have been with Raymond James Financial Services and other capacities for the last 19 years, and I've been fortunate to know you, Sherry, as a friend and mentor for many of those years. As I work to form a new planning practice located closer to my home near Ann Arbor in Dexter, Michigan, it seemed like a perfect match to join you, Sherry, and the Stephens Wealth Management team. We have similar philosophies on client care, and Stephens Wealth is always working hard to stay at the forefront of technology and wealth management trends, which made you an extraordinarily attractive partner.
Absolutely. We believe that we're a great fit with Melissa's firm. We are well known to each other, and we've collaborated closely for many years. We're delighted to have her firm affiliate with us, and Melissa and her team are a great complement in terms of their skills, experience, and advanced designations.
So as you can see, there's a picture of the members of the Pearl Planning team along with Sherry and Kim. We joined each other at the Pearl Planning launch party a couple weeks ago. So let's get down to business and talk about the topic of today. The Tax Cuts and Jobs Act, also known as TCJA, was passed toward the end of the year last year, but that did not affect your taxes primarily in 2017. The new law mainly came into effect in 2018, which means that until you file your taxes sometime in 2019, you may not fully comprehend how the changes impact you. So we want to be proactive and discuss with you, as we have been throughout the year, how the tax law changes may affect you so that you're not surprised as you're preparing your returns. First, there are new tax brackets, and these tax brackets largely, if you look at them on average, are lower. Certainly the intent of the law is that the average taxpayer will potentially have lower taxes, and that's what the estimates and analysis seem to indicate in terms of the new law. That's not a constant though. Over time there will be different impacts to people because of certain phase outs and changes. Additionally, you know that the average is not necessarily how you are impacted. So in fact, it is estimated that at least 5% of Americans will have increased taxes in 2018, even with the same financial circumstances, and that may grow over time. It's also noteworthy that the Tax Cuts and Jobs Act phases out many of the personal tax rates for individuals and families in 2025. So these are not permanent tax rates necessarily. So there have been some big changes in addition to the tax brackets with exemptions, which we've come to be very familiar with. So personal exemptions went away for individuals and married couples. And then the standard deduction, which was once at around above $6,000 for individuals and above $12,000 for married couples, was increased to $12,000, almost double for individuals, and $24,000 for married couples. What are the impacts of this? Certainly you itemize after you go over that standard deduction. So the number of itemizers is expected to fall by as much as 75%, according to the Joint Committee on Taxation, from 46.5 million Americans itemizing to about 18 million Americans. So that's a significant change and one that we're seeing impact many of our clients. The combination of both this higher standard deduction as well as specifics of what you can itemize, which Sherry's going to go over, are coupling to create that lowering effect.
So as Melissa mentioned, you may not be the average person, and there isn't a good way to generalize how this will affect you. It's very specific to your situation. So what you can itemize has significantly changed. So let's go over a few of the highlights therein. State and local income taxes, which we normally could itemize, and property taxes will be capped at $10,000 total. So you would add those two together and you cannot deduct anything exceeding $10,000. So that means if you had a second home and your property taxes are $13,000, you can only deduct $10,000. That's a big change, and I think a surprise to some. Mortgages previously up to $1 million were deductible. This year and going forward, new mortgages will be capped at $750,000. Also, home equity loans were an additional deduction. That interest used to be deductible. Going forward, that will be combined with the mortgage and cannot exceed that $750,000 number. Also, the way you use a home equity loan will determine whether it's deductible. It has to be used for real estate, either improving your real estate or buying real estate. It can no longer be used to pay off a car or paying off debt, as some people did in previous years. So before December of 2017, if you had $1 million mortgage and a home equity loan, you're okay. Going forward, the new rules apply. Charitable contributions are now capped at 60% of your adjusted gross income, and that is up from 50%. That's an increase. And medical expenses are deductible to the extent they exceed 7.5% of your adjusted gross, which is slightly better than last year and previous years, which had a 10% hurdle rate. Other miscellaneous itemized deductions are no longer deductible. This includes professional fees. Also, there is not a phase out any longer, as was in previous years, for high income earners. So you used to be able to have deductions, but to the extent that you had significantly higher income, those were phased out. So between the lower brackets that Melissa described and the higher standard deduction, for many it'll be a wash. but it's important to check with your tax professional to know exactly where you stand so you can plan ahead if there's any opportunities for you this year. A little more detail in terms of deductions. There's an expanded child tax credit. It applies for children 16 or younger. They must be a dependent, but it's now up to $2,000 per child. Keep in mind that's a tax credit, but there is a phase out beginning at $200,000 for single taxpayers and $400,000 of income for joint taxpayers. AMT. The bottom line is fewer people will be subject to the alternative minimum tax. This tax was, many people prior to now were subject to this tax because it wasn't indexed for inflation, and sometimes deductions threw you into that bracket. Now fewer will be, and significantly we think fewer will be subject to AMT. Some stock options still may qualify. So if you work for a company and you have stock options, you may want to run that by us and your tax professional to see if this might be a good year for you to exercise or if you should postpone. Business breaks were a big part of the tax law. The new code section lowers the bracket for qualifying businesses. It is now 20% for qualified business income from some partnerships like LLCs, S-corps, etc. So many types of companies, though, like physicians' practices, accounting firms, and even wealth management firms will not qualify, but there are many large companies like manufacturing firms that will. This was a big change. Also, in addition, college funds, 529 plans that have expanded in terms of their use. You can now use up to $10,000 per child per year for K-12, including private school education. This is a change. Some state taxes, however, will vary on this rule. Last, the estate tax and gift tax exemptions have doubled. They were already pretty generous at $5.6 million per person. It's now increased to $11,180 per person. So over $22 million per couple. This has effectively eliminated estate taxes for many households and has simplified estate tax planning. However, as Melissa mentioned, many of these provisions will sunset in 2025. So there may be, in the next few years, planning opportunities for us all to discuss in terms of should you take advantage of some of these tax changes going forward.
And estate taxes have been all over the place during my career, just the last 20 years. So certainly taking advantage of when there are windows where they are higher, there are certainly planning opportunities. So let's talk about, for a minute, Sherry, what are the implications for this conversation with you and your clients? Now, we've already said no one is the average, but what do you tell people when they ask, am I going to pay more or less in taxes?
And that's a great question, and the answer is it depends, right?
Mm-hmm.
So I spoke to a client recently who was surprised after knowing that her two homes, which had high property taxes, even though she lived in the state of Florida, would throw her into a higher tax bracket. So certainly, depending on the state you live in, like New York or California, where they have high state income taxes,
mm-hmm.
you may no longer be able to deduct, or you have some homes that have higher property taxes. The combination of those two might, in fact, throw you into a higher bracket. Others who didn't itemize much have now a much higher standard itemized deduction and a lower bracket. So those folks may actually end up in a lower bracket. So it's really hard for us to know unless we see the specifics.
So when I talk to clients too, we have to know the specifics, and we have the fortune of really knowing our clients over time, but proactively we need to know your current circumstances. I'm talking to clients about making sure that they are withholding the correct amount. to plan for cash flow into the new year. It matters what state you're in because of the changes in state and local taxes. And I'm going to talk in a moment about charitable giving, but that's certainly a new game unless you are giving very significant amounts because of the higher standard deduction. Then finally, we've mentioned two things at least that are changing. The current brackets are are going to be sunsetting unless law changes in 2025, as well as the state tax rules. So we are thinking when we do our financial planning projections to be able to compare and run out things both with and without the tax codes. And we're trying to be very flexible in anticipating planning and knowing there are certain times where you really need to be prepared to act quickly. So this is constantly changing in the context of both your personal plans as well as what the rules are based on what our government creates. And we're cognizant of both. We do not think that these tax rules today will be evergreen. So we plan with the context of both what we anticipate as well as what we know right now. So let me get a little bit deeper because many people give charitably, but not everyone gives enough that they'll be able to itemize in the new tax year. That change in the standard deduction is significant for a lot of people. And if you think about it, oftentimes older Americans who may have paid off their mortgages and the other things that kind of add up to your deductions are not going to be giving enough charitably, typically over $8,000 to $12,000 so that they hit that itemizing amount, but they still want to get both their charitable intent created with their gifts as well as a tax advantage if possible. So some of the things that we talk about with clients in those circumstances like you is potentially they may want to put 2 or 3 years together of their charitable gifts so that they get over the hump into itemizing once every 2 or 3 or 4 years. So if you know your intent to give over time and you also know that your typical annual amount of gifts is not going to get you over that hurdle to get you a deduction, then you may want to group your gifts either by communicating in advance with the charity that you're giving to or using what we call a donor advised fund, where you give either cash or appreciated stock to a fund and then immediately get a tax deduction at the time that you give it, but you're able to decide over time when and how to make gifts directly to the charities involved. Certainly this is a strategy that involves more conversation, but it's something that is becoming more and more relevant because of that significant reduction in those that are able to itemize. Also, it's always something to consider if you have appreciated taxable stock. That's perhaps you bought something for $10,000 and it's grown so it's worth $20,000 or $30,000. That's a future tax liability if it's in a taxable account. And if you gift appreciated stock directly to the charity instead of selling it and giving the cash, you've avoided a potential future tax liability. So the gift of appreciated stock, especially when you combine it potentially with a donor advised gift, it could be recommended. And then for those of you that are subject to a required minimum distribution in an individual retirement account or IRA, you may make a gift to charities that are qualified charitable distributions. This is giving directly to the charity instead of going through your bank account and then to the charity. And you don't get a deduction in that case, but you don't have the income of the distribution hitting your taxes at all. So that's something that may be effective, and a lot of retirees that I work with find it to be a strategy that fits in with what they would like to do with their charitable giving.
So let's switch gears just a little bit. If you're an employee, now is the season for enrollment. You probably have received a notice by now, but it's open enrollment for employers. So some of the questions you should ask yourself during this time of year are whether or not you're getting everything you need from a benefit standpoint. One thing to think about is your disability insurance. Do you have short-term and long-term insurance? If not, you can buy private insurance, but many employers offer it. Also, some employers offer health savings accounts as part of their medical insurance or HSAs. HSAs are a great way to save in a deferred way. Taxes are deferred, the earnings grow tax-free, and the money comes out tax-free, kind of like a Roth in terms of how you take the money out. There's no requirement that you take the money out. So if you put the money in and let it accumulate over years, at the moment, the law allows you to do that. So it's very much a benefit you should consider. Many companies offer life insurance, but it may or may not be enough, or it may be a defined formula. And it sometimes is and isn't portable. So you may want to understand whether or not you're properly insured. And if you have a health situation, it might be the only way you can get life insurance. So it can be a very important benefit for you at work. Another thing to think about is whether or not you're saving enough for retirement. 401ks, 403bs, deferred comp, etc. To the extent that they're available to you, we think you should be looking very carefully at saving as much as you possibly can for retirement, either before or after tax, depending on what makes sense in your situation. And you also may want to look at your asset allocation within those accounts. Is it appropriate? If you're uncomfortable with how much fluctuation you've seen recently in your accounts, maybe you should talk to us and we can help you determine whether it's an appropriate risk profile or not. Last, the healthcare exchanges are open November 1st through December 15th, where they post premiums and the new plans for next year. And some changes always occur. So you do not want to continue a plan without understanding whether some of those benefits have changed in your current plan. Also, in terms of enrollment, it's the time to consider your Medicare coverage. My husband last year became Medicare eligible, and it's complicated. Even as much as I know, we're going to need some help evaluating all the provisions that are available. He's healthy, so maybe he can save on premiums, but if you have health conditions or have particular prescriptions that you need, the type of plan that you have will be critical in terms of helping you have the right package. The good news is that we have resources to help you. Raymond James has partnered with a firm called Health Plan One. We have the number on your screen, but it's 844-269-2646. They're experts in this field, and they can help you. They're agnostic around the type of plan that you have. Their job is to help you evaluate where you are and determine what options are available to you and help you implement those.
And that's very beneficial, and certainly things change over time. So just leaving things in the default, which is what studies show is typically happens, whether it's open enrollment or Medicare, it's always beneficial to review and make sure that the default or what you had before is still appropriate. So let's drill down and just say the biggest things that we're mentioning to clients year in. First, if you have questions, of course, give us a call, because your circumstances are personal and specific to you. But some things that I always think about and have changed slightly this year because of the Tax Cuts and Jobs Act. First, you need to manage for your retirement distributions if you're in early retirement, or potential Roth conversions if you have the opportunity in a lower tax bracket, more effectively, and this may be towards the end of the year, because you're watching both cash flow as well as what your income tax circumstances are going to be for the year. Maybe you retired in the middle of the year, so this is a low year before you start taking distributions next year. There's a variety of circumstances. But make sure you're conversing if you have an unusually high or low tax bill you think this year. And then I mentioned earlier that intentional charitable giving, not only making your gifts match with what is important to you, but also doing it in the technical financial way that will be most effective for your tax brackets is becoming more and more important. Then, of course, just on a personal level, you get together with your family. We love to see holiday photos, and we know that Thanksgiving and the holidays are a time of year where it's natural to spend more time with family and loved ones. And this is a great opportunity and time to share stories about the legacy that your family has, or discuss money needs, especially across generations. Certainly something that is helpful around the holidays. And Sherry, you've worked with a planning tool, Everplan, that also helps to communicate across generations. Can you describe that?
Sure. Everplan is a tool that we offer clients to help them share information with their heirs or whoever else they choose. So it's like an electronic, secure safety deposit box. So your will is the what of what you want to leave your heirs and how you want your effects to be handled. And Everplans is online and secure, but it helps explain the why to your family. Maybe you're not ready to talk about that right now, but you know exactly what you want and when you want it done. So it stores all the information that you choose to provide in one place, and it can be shared on your terms, on your timing.
And we certainly care within both of our practices about wealth management for the whole family. So we're always thinking about that time, those times where your FaceTime is actual real FaceTime, not digital and on a screen, and what opportunities you can provide to each other. And then certainly in a year like this, where we started the year down, then made up for all of those losses and went into the positive territory, and then have come back down more recently, there's some opportunities to review and effectively manage portfolios for tax management, make sure that the tax costs of investments, when possible, may be able to be reduced. And so that is something that, if you have outside accounts that are taxable accounts, should certainly be looked at and considered, is how effectively are we managing for taxes within accounts.
So it's been a long time since we've been able to harvest tax losses. So we want to take that opportunity when we can, as Melissa mentioned. If your income for this year will be low, you really do need to consider in what ways can we take advantage of that opportunity. Review your tax withholdings. You may be over or under withholding. Defer or accelerate business expenses. And for sure, evaluate your cash flow and your plans for 2019.
A couple housekeeping notes too. We want you to be aware that we have reports that can show you your current tax liabilities year to date. Of course, those are not a final, they're not a replacement for your 1099, but we can kind of give you an estimate of where you're at tax-wise within your investment accounts that we manage. So don't hesitate to reach out and request those reports if you ever are looking for them. And that's also something I also offer to tax professionals that you work with as well. We're happy to provide information via tax snapshots. And then we know that next year we'll quickly be talking about your 2018 tax season, which happens at the beginning of the year, right? So in anticipation of that, we'd like you to know that retirement and education savings account forms become available from Raymond James by January 31st. But in order to avoid changes and surprise amendments on your 1099s from your Raymond James accounts, the first batches are sent on February 15th or right around there. And then there are follow-up batches for those likely to be amended February 28th and March 15th. So be aware and don't expect that you'll be receiving your 1099s in the month of January. They come a little bit later. And as always, if you have questions related to your account, your taxes, or year-end planning, we love to help you. And it's not generalized, it's personal to you. So don't hesitate to contact either of our offices with any questions that you may have.
So thanks, Melissa. We hope this has been helpful to you. We've covered a lot of information. So our contact information is on the screen. Call us if you have any questions. It's a pleasure to help you anytime, but especially during a time when taxes are changing and we're getting towards the end of the year.
Thanks, and have a wonderful Thanksgiving.